Welcome back. It's good to see you. I mean, it's obviously so easy to be bearish. All you have to do is tune into any, program, and most people who come on lay out the negative case because it's easy to make. But why are you?
Yeah, the bearish narrative is easy to make, and I'm going to start by saying I'm not an uber bear, but I do think that it makes sense right now to be underweight stocks. I mean, just think of the bearish narrative, and you just had a guess kind of go through it. The yield curve is inverted 80 basis points. PMIs are dropping like a rock. Manufacturing down 16 points. Services down 20 points, even though they've jumped back up. Inflation is sticky. You had a guest talk about the equity risk premium. It's as compressed as it's been since the great financial crisis. Earnings expectations look high at 3.5%. Our models predict that housing could go down 7 to 10% this year, and on and on. The leading indicators are flashing red. We've had a few good prints, retail sales and employment and so on, but really the bearish truck is coming, Scott.
I know, but there's no indication that the bearish truck is going to, smack into the wall. If look, Jamie Dimon has been, notable for being out there with some, pretty bleak calls when he talked about there being a hurricane. And I know that you know exactly what I'm referencing. And he was on the network today, and he could have doubled down on that. And frankly, he did not. He still maintains there's a chance for a soft landing. Bullard, economy stronger than we thought. Markets overpriced a recession in 2023. Have we just gotten too uber negative given how strong the economy, at least at this moment, still appears to be?
I think so, Scott. And I heard Jamie Dimon, and he was more nuanced today. And one of the reasons why this uber bearish set of data has to be interpreted a little bit differently is that we still have about $2 trillion of accumulated savings. Now, the bears will all say, and again, I'm one of them, I'm just a more nuanced bear. They'll all say, well, we're drawing down on these savings, but $2 trillion of accumulated savings going into a recession is a very unusual, never seen before situation. And you had Stephanie earlier talk about the consumer and the strength of the consumer, 3%, retail sales in January. That's pretty good. The employment market is just really strong. And yes, everybody will say, the bears will say, look, it's just a lagged effect. And I agree with it. You have to wait it out. You've had 475 basis points of hikes. Let's see. Let's let time pass to see how this is going to unfold. There is a lagged effect. And employment is a lagging indicator. But still, I mean, we just created 517,000 jobs. And the claims are coming in low at 192,000. So after 475 basis points of hikes over a year, we have a 50-year low in unemployment. So there's something about the response function of the labor market to the Fed tightening that makes it look quite resilient.
At least at the current time. Now, you say you are playing quote unquote aggressive defense. What does that mean?
We talk about the market being expensive at 18 price earnings ratio. There are areas in financial markets that asset allocators are getting pretty interested in because they are actually cheap. I talk a lot about quality small caps, the S&P 600. The price earnings ratio there is so depressed to 2008 financial crisis level. It's hovering around there. So to me, those quality small caps are pricing in a very hard landing. So I'm comfortable, and it's nuanced, playing offense and defense. I'm comfortable being underweight stocks, having a cash buffer, waiting to get back in, but at the same time, being long small caps. No one wants to be long small caps into a recession. This is actually right now an opportunity to be contrarian and add some juice to the portfolio for the next 12 months. I happen to think that high yield bonds at over 9% yield are attractive as well from an asset allocation perspective.